Welcome to the deep dive. If you've been watching the market lately, it feels like investors are just, swimming in information, maybe drowning sometimes.
Yeah, it's a lot. Every headline, every bit of data seems to pull things in a new direction.
Exactly. What felt, pretty stable just yesterday can feel completely different today. We're seeing some really big shifts that honestly demand a rethink.
Hmm.
So today, we're going to take a deep dive into the U.S. equity market. We're zeroing in on the absolute latest analysis and tactical plans for July 16th and 17th, 2025.
Right.
And our goal here is really to cut through all that noise, try to clarify these signals that often seem to conflict, right?
Yeah, they definitely do.
And pull out the really crucial bits of knowledge. Ultimately, we want to give you, the listener, a clear point of view, some actionable advice, and a well-defined plan for navigating what feels like an incredibly complex environment right now.
And we're not just going to tell you what happened.
No,
We want to show you how to think about these events.
that's the key, how to
Yeah.
think about it.
And to do that, we've really synthesized insights from a pretty comprehensive market analysis. We're blending different approaches, things like Bayesian inference, scenario planning.
Okay.
What's truly fascinating, I think, is just how quickly new evidence can force us to completely reshape our entire belief system about the market.
That idea, reshaping the belief system so fast, can you give us a concrete example? Like, how did that play out in just the last, say, 24 hours? Where did new data force a real rethink, not just a tiny adjustment?
Okay, think of it like this. Just yesterday, a lot of folks were wearing what we might call Goldilocks glasses.
Right, everything's just right.
Exactly. They saw this world where, strong corporate earnings could sort of magically offset inflation, make everything okay. But then, boom, fresh high-impact data landed. And it wasn't just one bad number. It felt like a crack in that lens. It forced us to take those glasses off and see the market in a completely new and, frankly, far less rosy light. That's the belief system getting reshaped right there.
Right.
Our prior assumptions, they've been pretty fundamentally updated.
So what's the new reality then?
The market's now navigating this heightened uncertainty. Political risk, interestingly, is becoming a primary pricing variable. It's even starting to overshadow some of the purely economic inputs sometimes.
Wow.
So that whole Goldilocks view, it's basically been fractured by, let's say, three critical clusters of evidence that just emerged.
Okay, let's unpack those. What was the first pillar to crumble?
Well, the first shoe to drop, and it surprised nearly everyone, was economic growth.
The GDP numbers.
Exactly. We saw a shocking first quarter 2025 GDP contraction, minus 0.5% at an annual rate.
Minus 0.5. Wow, that's a huge reversal from the, 2.4% growth just last quarter.
A stark reversal. And look, this wasn't just some isolated blip. We can connect this directly to weakening consumer data from May.
Okay.
Personal income down 0.4%. Personal consumption expenditures fell 0.1%.
Sure.
Add to that, the U.S. trade deficit widened substantially. So all this together just directly contradicts that strong economy story people were clinging to.
And it brings up that dreaded word.
Stagflation. Yeah, it introduces a very tangible risk of stagflation. And stagflation, it's really the worst of both worlds for an economy.
Right. Slow growth, high inflation.
Think of it like your car barely moving forward. That's the slow growth. But the engine is overheating, burning tons of gas. That's the persistent inflation. It's a total nightmare for central banks.
Because their tools work against each other.
Precisely. Tools to fight inflation often slow growth even more, and tools to boost growth can make inflation worse. It's a real bind.
Okay, so growth crumbled. What's the second cluster of evidence?
Then there's the inflation picture itself, which has become incredibly ambiguous, muddy.
How so? We got the June CPI report, right? Consumer Price Index.
We did. And it showed a 2.7% year-over-year increase. That's the highest since February.
And that initially poured cold water on rate cut hopes, didn't it?
It did initially. But here's the curveball. What about the data that came after that? The Producer Price Index, the PPI.
Okay, what did that show?
It was softer than expected. PPI measures wholesale prices, what businesses pay. And that data showed wholesale inflation rising less than economists thought.
So consumer prices sticky, but producer prices maybe easing.
Exactly. And this conflict, this difference, it creates a real conundrum for the Federal Reserve. Because it essentially gives them justification for almost any policy path they choose. Hold, cut, hike. You could argue for any of them based on this data mix.
Which means less predictability for the market.
Significantly less predictability. Yeah.
Okay, this is getting complicated. What's the third factor? You mentioned politics.
Right. And here's where it gets really interesting and maybe a bit unsettling. The sudden reactivation of political intervention as a market driver.
What happened specifically?
We saw some significant intraday volatility, big swings, caused by reports that President Trump had discussed the, quote, concept of firing Federal Reserve Chair Jerome Powell.
Whoa. Okay, that's major.
Yeah. The S&P 500 immediately dropped 0.7% just on that news.
And
Then it recovered after the president stated that such a move was, quote, highly unlikely.
but the damage was done, in a sense.
Well, the sequence established a direct causal link between a political headline and asset prices, right there in real time.
So it introduces...
It introduces a significant political risk premium into the market. We're not just trading economic data anymore. The market is now actively trying to price the perceived stability and independence of the central bank itself.
And that's inherently unpredictable.
Absolutely. It's a bit like, trying to drive your car while someone else occasionally grabs the steering wheel. Makes things very jumpy.
Okay, so let's recap. We've got crumbling growth, ambiguous inflation signals, and this new political drama injecting uncertainty.
Right.
It feels like that simple earnings-driven story we started with is just completely dismantled.
It really is. It's replaced by this complex, multivariable environment. And the Fed, you see, they're now walking this incredibly fine tightrope.
How so?
On one side, they risk tightening policy too much and pushing an already weak economy into a deeper slowdown.
Okay.
On the other side, if they ease too soon, they risk appearing to be swayed by political pressures, undermining their credibility. Both paths are just fraught with danger.
And the market knows it.
The market knows it, which ramps up the uncertainty.
So, based on this updated view, this new reality, how are you thinking about the immediate future, say the next trading session or two?
Well, based on this updated belief system, we've actually modeled out 3 distinct scenarios for the upcoming session, and we've assigned probabilities to them.
Okay, let's hear them.
First, there's what we call a hawkish hold risk-off scenario. We give this about a 35% probability.
Hawkish hold, meaning the Fed stays tough.
Right. They focus on that higher CPI number, maybe emphasize their independence. In this world, capital probably rotates into defensive sectors. Think healthcare, utilities.
Like Johnson & Johnson, maybe? We'll talk about them later.
Exactly. Johnson & Johnson's strong earnings fit right into that narrative.
Okay, 35% chance of risk off. What's scenario 2?
Second, the dovish tilt risk-on scenario.
Yeah.
This one we see as slightly more likely, maybe a 45% probability.
Dovish tilt, risk on, so the opposite.
Pretty much. Here the market focuses more on that weak GDP report, the softer PPI data. The interpretation is the Fed might have to pivot towards supporting growth.
And the Trump-Powell comment?
In this scenario, it's seen as mostly noise, sort of de-risked already. This kind of environment would likely be favorable for the NASDAQ, for growth stocks.
Like NVIDIA, Palantir.
Those are the kind of names that could benefit, yeah.
Okay, so 35% risk off, 45% risk on. What's the last 20%?
The final one, with a 20% probability, is a volatility spike sideways chop scenario.
Sideways chop sounds messy.
It is. This is where those conflicting signals, we talk about the GDP versus CPI, the politics, they just lead to investor paralysis. Nobody knows which way to jump.
So the market just churns.
Yeah, you get volatile, range-bound trading, lots of noise, not much direction. And interestingly, Goldman Sachs has pointed out that market breadth is already extremely narrow.
Meaning just a few stocks are driving the gains.
Exactly. And that narrowness often precedes this kind of choppy consolidative action. So 20% chance of just, messy sideways movement.
Okay, that macro picture is definitely complex. Let's shift gears now and transition from that big picture down to specific stocks. Because even in a choppy market, there can be opportunities, right?
Absolutely. But it's crucial, now more than ever, to look beyond just the headlines for a stock.
Yeah.
You need to understand why that specific stock is relevant right now. What's its actual catalyst?
Right. Not just a general feeling, but a specific reason.
That's exactly our approach. We call it a first principles approach to stock selection. It ensures we're grounded in what's actually happening in the market right now.
So what does that involve?
Each potential trade we look at, it needs a few things. 1, a clear and recent catalyst. Something specific happened. 2, a measurable market reaction. You see it in the price, you see it in the volume.
Okay.
And 3, a traceable source of sentiment. You can point to why people are suddenly interested.
Got it. Clear catalyst, market reaction, sentiment source. So let's apply that. Let's start with Johnson & Johnson, J&J. You mentioned it fits the defensive theme. What's its specific catalyst right now?
Okay, J&J. In this uncertain economic backdrop, it's acting exactly like you'd expect a defensive anchor to act. It's a play for safety, quality, predictable cash flow.
And the catalyst.
The big catalyst was their Q2 2025 earnings report. They delivered a significant beat on both earnings and revenue.
Okay, good numbers.
But most critically, they raised their full-year guidance.
Ah, that's the key signal, raising guidance in this environment.
It's a powerful signal. It shows management's confidence when maybe other companies are getting nervous. And the market reaction, immediate.
What happened?
The stock surged over 6% on nearly triple its average daily volume.
Wow, triple volume. That's significant buying.
It confirms institutional capital is flowing into J&J. It's a clear move toward safety, a safe haven play.
Okay, clear catalyst, big reaction. Now let's flip to the other side of the coin. Growth. NVIDIA, NVDA. Still the king of momentum, the leader in AI. What's driving its very latest move?
Yeah, NVIDIA, it's still, the undisputed leader of that whole artificial intelligence secular theme.
Yeah.
The driving force behind its most recent leg up was some very high-impact news. The U.S. government provided assurances, basically, that it will grant licenses for NVIDIA to resume sales of its H20 AI chips to China.
Ah, the China sales issue. That's been a cloud hanging over them, hasn't it?
A significant cloud. It removes a major geopolitical and revenue overhang. People were projecting this could impact revenue by as much as $8 billion.
So lifting that uncertainty is huge.
Huge. It essentially de-risks the stock in a fundamental way.
Yeah.
And that directly fueled a 4% rally, pushed it to a new all-time high, and incredibly passed a $4 trillion market cap.
$4 trillion. Just amazing. So again, clear catalyst, clear positive reaction.
And a fundamental positive that clears a major hurdle.
Yep. All right, next up. Global Payments, ticker GPN. Now this one sounds different. You said it's been a huge laggard, down 55% over 5 years.
Yeah, GPN has definitely been in the doghouse, a major underperformer in the fintech space.
So it sounds like a troubled company. What makes it suddenly interesting right now? What's the catalyst?
The catalyst here is very fresh, very potent news. Elliott Investment Management.
Ah, the activist fund.
A very same, an aggressive activist fund. News broke that they've accumulated a significant stake in GPN.
And Elliott doesn't just buy stocks to hold them passively?
Not usually, no. If we connect this to the bigger picture, Elliott's involvement instantly shifts the narrative. It shifts sentiment towards unlocking shareholder value.
Meaning they'll push for changes.
Their track record is all about shaking things up, forcing change, maybe asset sales, a strategic review, even an outright sale of the company. The market knows this.
And the reaction?
The stock surged 6.5% immediately on the news. That signals traders are now pricing in some kind of positive corporate event down the road.
Okay, so the catalyst is the activist involvement itself.
Exactly. Very event-driven.
Interesting. Now let's talk Palantir, PLTR. Another AI player, but maybe a challenger. It's had a massive run, up 114% in 6 months.
Yeah, Palantir's run has been incredibly powerful.
But the valuation?
Yeah.
You mentioned a PE over 239. That sounds astronomically high. Can you quickly explain for listeners what that signifies?
Sure. A PE ratio that high, over 239, it's incredibly rich. It means investors are paying a huge premium today based on expectations of absolutely explosive future growth.
So they're betting heavily on the future.
Very heavily. It's like paying for a Formula One car based purely on its potential to win championships years from now, even before it's fully built. It implies a higher degree of risk if that growth doesn't materialize exactly as hoped.
Got it. So with that high valuation, what's the recent catalyst keeping it going?
The catalyst here is actually quite rare and notable. It was an upgrade from a Mizuho analyst, Greg Moskowitz.
Okay.
What's significant is that Moskowitz was previously quite bearish on the stock. He had an underperform rating.
So he was a skeptic.
A known skeptic.
Yeah.
And he just upgraded his rating to neutral. Still not bullish, but moving away from bearish. And his reasoning cited the potential for accelerated revenue growth.
Why is a single analyst upgrade and only to neutral so important here?
Because when a prominent prior skeptic changes their tune, even slightly, it forces other skeptics to pause and reconsider their own negative positions.
It might make short sellers nervous.
Exactly. It can potentially contribute to a short squeeze dynamic where those betting against the stock feel pressure to buy back shares, pushing the price even higher. It validates the bull case somewhat.
Okay, interesting dynamic. Finally, Opendoor, ticker Open. This sounds like a totally different beast. You mentioned meme stock ingredients.
Yeah, Open is exhibiting that classic trifecta of meme stock ingredients right now. It's got the fuel, the spark, and the accelerant.
Okay, break that down. What's the fuel?
The fuel is critically high short interest. Over 20% of the company's publicly available shares, the float, are sold short.
So a huge number of people are betting against it.
A very large bet against it. That creates the potential for a squeeze if the price starts rising.
Got it. What's the spark?
The spark with a massive surge in social media chatter. We saw page views on StockTwits for open jump 400%. Discussions exploded on Reddit's Wall Street Bets forum.
So intense, retail investor interest suddenly ignites.
That's the spark. And then the accelerant.
Which is?
Record-breaking trading in bullish call options. Over 560,000 contracts traded recently. That's basically leveraged bets that the stock price will go up significantly.
Wow. Fuel, spark, accelerant. What was the result?
The result was a 90% price surge in just 2 days.
90%.
Driven almost purely by speculative sentiment, social media hype, and that potential for a short squeeze. Very little to do with company fundamentals at this point.
Okay, that's a wild one. Now, a key challenge in a market like this is that signals often conflict, right?
All the time.
You might see strong news for a company, but then a technical chart looks worrying, or vice versa. When you're looking at something like NVIDIA, for example, great news on China sales, but maybe technical indicators are flashing overbought. How do you wrestle with those? What stands out to you when you see conflicting pieces of information like that?
That's honestly where the real insights come from, wrestling with those contradictions. It's where the aha moments can happen.
Okay.
We absolutely have to resolve these conflicts. We use, well, Bayesian thinking is one way to frame it.
Huh.
And also something like a tree of thoughts approach.
Tree of thoughts.
Yeah, it just forces us to rigorously ask, what's the newest, most impactful piece of evidence here? And how does it force us to completely update our prior assumptions, even if some older data points in a different direction?
So prioritizing the new high-impact info.
Exactly. Let's look at those two specific examples you mentioned, NVIDIA and global payments, because they illustrate this perfectly.
Okay, NVIDIA first. The conflict is the strong bullish fundamental news resuming China chip sales, a major de-risking event.
Right, a huge positive fundamentally.
Versus the technical signal. The 14-day relative strength index, the RSI, is above 70, which is typically considered overbought.
Correct. The RSI is basically like a speedometer for price momentum.
Uh-huh.
Above 70 suggests the stock has gone up very fast, very recently, and might be due for a pause or even a pullback. It's a common short-term warning sign.
So fundamental good news versus a technical warning sign. How do you resolve it? Which signal wins?
Our resolution here leans heavily on the nature of the news. The China news represents a structural improvement to NVIDIA's investment thesis. It's a forward-looking catalyst. It removes a major risk. The market must, over time, price this positive development in.
Okay.
An overbought RSI, while definitely a valid warning for short-term traders, is fundamentally a lagging indicator. It tells you what has happened recently. And strong stocks can stay overbought for long periods during powerful uptrends.
So the fundamental catalyst is seen as more durable.
We see it as a more powerful and durable signal than a short-term technical condition in this specific case. Therefore, our final bias for NVDA remains bullish. We'd assign maybe 75% confidence to that bullish view, acknowledging the short-term overbought reading.
Okay, that makes sense. Now, global payments, GPN. The conflict here is the fresh, bullish news, Elliott management taking that activist stake, driving a powerful technical breakout from its long slump.
Right, a very positive catalyst confirmed by the price action.
Versus a quantitative signal from the options market. You mentioned a high put-call open interest ratio of 1.9 year. What does that mean, and why is it conflicting?
Okay, the put-call ratio compares the number of outstanding put options, bets the stock will fall, to call options, bets the stock will rise. A ratio of 1.90 is quite high, meaning there are almost twice as many puts open as calls. This suggests that before the Elliott news broke, the prevailing sentiment among options traders was actually bearish. They were positioned for downside.
So the options market data reflects past sentiment.
Exactly. That's the key insight. The activist news is a new, high-impact, and likely overriding catalyst. It fundamentally changes the game for GPN. That bearish options positioning reflects sentiment from before anyone knew Elliott was involved.
So the catalyst trumps the lagging options data.
In event-driven special situations like this, absolutely. The catalyst itself becomes the primary signal. It acts like a reset button for market sentiment. As the stock rallies because of the Elliott news, those old bearish put positions will likely be closed out, maybe at a loss, and new bullish call buyers will start entering the market, changing that ratio over time.
So the options data is basically old news in this context.
It's looking in the rearview mirror. The catalyst is looking forward. So our final bias for GPN is firmly bullish. Given the strength of the catalyst, we'd put maybe 80% confidence on that,
Okay, that's a great illustration of resolving conflicting signals. So we've unpacked the macro shifts, we've dug into specific stock catalysts, resolved some conflicts. Now, the big question, what does this all mean for you, the listener, and your strategy? How do we translate this deep dive into concrete action?
Right. This is where the rubber meets the road. All this analysis, it needs to translate into clear, executable trading plans. The goal here is to remove emotion and hesitation from your decision-making process.
Giving people a framework.
Exactly. We're not just throwing out numbers. We're showing you the logic behind specific entry triggers, targets, and stop losses.
Okay, let's run through the plans for the stocks we discussed, assuming a bullish scenario unfolds based on our analysis. Start with J&J.
All right, for Johnson & Johnson, J&J, the bullish plan looks like this. The trigger is if the price holds firmly above that post-earnings gap support level around $162. That level is where the market showed strong buying interest after the good news.
So holding above $162 is the green light. Target.
Our target is $169. This might be based on a previous resistance area or a valuation metric.
And crucially, the stop loss. Where do you admit you're wrong?
The stop loss is a close below $161.50, just below that key support. This clearly defines your risk versus the potential reward based on that earnings catalyst.
Okay, J&J, plan clear. How about NVIDIA, NVDA?
For NVIDIA, NVDA, given its strength but also that overbought condition, the trigger is if the price can consolidate a bit and then hold above $178.
So let it prove it can hold that level.
Yes. The target we're looking at is $178, and the stop loss would be a close below $168.50. This acknowledges this momentum but sets a clear boundary if the uptrend falters.
Got it. Global payments, GPN, the activist play.
For global payments GPN, the bullish trigger is a clear break and hold above the resistance level of $83.16. That's a key psychological barrier it needs to overcome to confirm the new trend.
Breakout above $83.16.
Sure.
Target.
Target is $92, looking for a more significant move based on the activist catalyst. The stop loss is a close below $80.50. This leverages that Elliott news for a potential major trend reversal.
Okay. Palantir, PLTR. Higher risk here.
Definitely higher risk due to valuation. For Palantir, PLTR, the bullish trigger is decisive break and hold above $150. Another key round number.
Target and stop.
Target is $160, a shorter-term momentum target, and the stop loss is a close below $147. Because it's higher risk, defining these entry and exit points tightly is even more critical.
Makes sense. And finally, Opendoor. Open, the speculative one.
And let me stress again, Opendoor open is strictly for aggressive risk profiles only. This is not an investment.
Understood. Lottery ticket territory.
Pretty much. The trigger here could be if the stock gaps up strongly in the pre-market session and then holds above $1.50 after the market opens.
So immediate follow-through is key. Target.
The target is honestly hard to pin down, precisely because it's driven by speculation, not fundamentals. Let's say $2.50 plus the TOG. But emphasize that price discovery here is highly unpredictable. It could go higher, it could collapse.
And the stop loss is absolutely critical here.
Absolutely crucial. A hard stop loss below $1.30. If it breaks that, get out immediately. Capital preservation is paramount in a purely speculative trade like this if it doesn't work out quickly.
Okay, those are clear plans. Beyond those specific stock triggers, are there broader strategic insights or maybe second-order effects we should be thinking about, especially given this fragile market you described?
Yes, absolutely. It's important to think beyond just the individual stock trade. Consider NVIDIA again.
Okay.
The positive news for NVDA is great for that stock, obviously, but it has a second-order effect. It tends to lift the entire semiconductor sector. You see the ETF, SOXX, move with it. This reinforces that market narrative we talked about, that maybe AI is the only game in town for growth right now.
Which sounds good, what you said, that creates fragility.
It does, because that leads to a potentially dangerous third-order effect, increasing market fragility because so much capital gets concentrated in just a handful of AI-related names. Goldman Sachs, as we mentioned, noted market breadth is at its lowest since 2023.
So if those few leaders falter, the whole market could suffer disproportionately.
Precisely. So strategically, having a trade like J&J in your thinking, that defensive anchor, it actually serves as a partial hedge against a potential tech-led downturn. It provides some balance.
That's smart. Thinking about how trades interact. What else?
We can actually use J&J itself as a kind of real-time indicator.
Yeah.
Watch how capital flows into J&J relative to high-beta tech stocks like those in the NASDAQ 100 ETF, QQQ.
So like a J&J QQQ ratio.
Exactly. Or even the healthcare sector ETF, XLV versus QQQ. If J&J or XLV is outperforming QQQ strongly, it's a live signal that market-wide risk appetite is shifting towards risk-off, confirming defensive positioning is warranted. It's a live barometer.
Interesting tactical tool. Any ripples from the global payments situation?
Yes, the activist ripple effect. The Elliott management news for GPN could, and likely will, shine a spotlight on the entire undervalued fintech sector, particularly payment processors.
So investors might start looking for the next GPN.
They might start reevaluating other companies in that space that have lagged. So strategically, while GPN itself is our high-conviction primary trade idea here,
Right.
a secondary, maybe lower conviction tactical trade could be considered. Perhaps something like long call options on the broader financial select sector SPDR fund, the XLF, to capture a potential positive ripple effect across the whole sector if GPN lifts sentiment.
Okay. That's thinking several steps ahead. So let's pull it all together. If you had to rank these trade setups based on everything we've discussed.
Sure. Based on the freshness of the catalyst, the clarity of the path to value, and the risk-reward setup, I'd rank Global Payments, GPN, as the highest conviction right now. It's a classic event-driven situation with a clear driver.
Okay, GPN number 1.
J&J comes in as a strong number 2. It's a solid defensive play, acts as that portfolio ballast, and has clear post-earnings support levels to trade against.
J&J number 2.
NVIDIA is third. Undeniably powerful momentum, strong fundamental news, but you have to respect the stretched technicals and manage the risk carefully.
NVDA third.
Palantir is fourth. Also strong momentum, but the very high valuation and more polarized sentiment make it a higher risk proposition than NVDA, requiring tighter stops.
PLTR fourth.
Wow.
Which leaves.
And Opendoor? Open is firmly at the bottom, rank 5. Let's be crystal clear. This is a purely speculative, extremely high-risk lottery ticket, suitable only for the most aggressive risk profiles with capital they can afford to lose, not an investment.
Got it. GPN, J&J, NVDA, PLTR, and Open Last with a huge warning label.
Exactly. Look, in today's market, it's just so dynamic. You've got macro trends, political headlines, specific company catalysts all swirling around and intertwining.
It's a lot to track.
It is. But understanding these conflicts, knowing how to approach resolving them, using frameworks like Bayesian thinking, or just prioritizing new, impactful information, that's what really leads to deeper insights. That's how you gain an edge beyond just reacting to headlines.
It's about the process, not just the outcome of one trade.
Precisely. Better decision-making over time.
So as you, our listener, go forward from this deep dive, maybe remember that inherent tension in the market. Those seemingly conflicting signals are everywhere. The real question is, how will you use these kinds of insights, this commitment to continuous learning, this willingness to adapt your own prior beliefs based on new evidence, to navigate these constantly evolving market narratives?
Because the market never stops teaching lessons.
It certainly doesn't, and neither should we. We really hope this deep dive has given you a clearer point of view today, maybe sparked some ideas, and provided a bit of a defined plan.
Hope it helps cut through some of that noise.
And for the fastest, most frequent updates, making sure you stay ahead with expert analysis and actionable strategies tailored just for you, please be sure to subscribe to The Deep Dive. We'll be back soon with our next analysis.